Cool. Looks like we're live. It looks like we've got quite a few participants in the audience as well. So just drop a message into the chat. Let me know if you can hear my voice okay. Just want to do a quick sound check before we jump into it. See, there's a few more people joining. Hey, Jacob. Nice to see you in here. Appreciate you joining today. Just drop a message in the chat. Let us know if you can hear my voice. See the screen okay as well. I should have the slides up on the screen. Hey, Brandy, nice to see you. Appreciate you joining today. Very excited. Hey, Amber, nice to see you in here. Hope you're having a great day. Val, nice to see you as well. Appreciate you joining. Cool. We'll give it a few more moments here. Hassan, nice to see you as well. I don't know. Can you see the chat, Thomas?
Yes, I see this chat on the right-hand side of the screen.
Awesome.
Hey, everybody.
This is Thomas, CPA, and also host of the Tax Smart Insiders community as well. So he'll be joining us today and sharing some really good advice, especially around Schedule E, as we are mid-tax season. Tax deadline is upon us, and this is basically the time to really learn about Schedule E, particularly if you're a real estate investor, and how that whole tax return is going to work for you. Hey, Tamika. Hey, Ryan. Hey, Hassan. Appreciate everyone joining today. So let's kick off. I'm just going to do a little bit of an introduction. You may have not met us before. So this webinar is all about tax preparation, Schedule E, categories explained. And my name is Logan Ransley, one of the co-founders of Landlord Studio property management software. And we are joined here today by Thomas Castelli. So Thomas is a seasoned real estate investor, licensed CPA professional, financial advisor, and obviously the host of the Tax Smart Real Estate Investors podcast as well. And he's got a ton of awesome content and projects that he's working on specifically around real estate tax and how you can really just make the most of your tax advantages you have with real estate. So really appreciate you joining us today, Thomas. Thrilled to have you with us.
Thank you for having me.
So let's sort of jump into it. I just want to set the scene. So in the past, landlords have relied on sort of messy spreadsheets, sheer determination to sort of navigate the complexities of tax preparation. It's a sort of strategy that at best leads to stress and filing errors, and at worst could result in overpaid taxes or even, a tax audit. But doesn't really have to be that way. So in today's sort of webinar, we're going to go through everything that you need to know to efficiently complete your tax preparation and tax return, from deciphering key tax forms to mastering sort of rental property tax deductions. And we're also going to introduce how modern solutions like Landlord Studio can make that process just much more accurate, much more efficient, so you can minimize your tax liabilities and ultimately maximize the ROI of your real estate portfolio. So the chat in this webinar, if you have any questions regarding tax preparation or any questions about this webinar at all, just feel free to drop the questions into the chat below. We're going to have a bit of a Q&A right at the end of the webinar, and that'll give us a bit of time to dive into specific key questions that you might have. So if you have any questions as we go through, drop them into that chat. We'll make sure that we address those throughout and at the end of the webinar as well. So let's jump into it. So let's start with sort of the part one of I guess tax preparation. So many landlords sort of struggle to keep up with changing regulations and tax requirements. And additionally, there's this big fear of making errors and the dread of an IRS audit can sort of lead to significant stress in this process as well. Maybe you've experienced this before, maybe you've been on top of it before, but there is this sort of underlying stress that sort of sits in the background to make sure that you're doing it correctly. So one big mistake that we see time and time again is just the lack of proper record keeping. And when we ask customers what made them change from things like spreadsheets and paper and the sort of manual method of doing tax preparation or even just your bookkeeping, it's often, I mean, the answers often vary, but they often find it hard to stay on top of finances. And it's not often until after they've made that change into software and systemizing processes and using automation do they really realize how bad what they were doing actually was. And we've got some great case studies of this as well. We had one customer, realize that he was only making $14 of profit on his rental properties per month because he just didn't understand the expenses, the outgoings, didn't understand income, etc. So what we really see is just this sort of confusion and this lack of insight and lack of understanding of how a rental property portfolio really, or how it's actually working when you're not using these sort of automated tools. So I guess this is where I really want to get some of your insight, Thomas. So one of the questions we sort of had for you is, what are some of the sort of challenges that you've seen with landlords, and what's the sort of role of establishing a good bookkeeping system as the foundation for a rental property business?
Yeah, no, absolutely. It's a great question. And, you hit the nail on the head before. Record keeping is often one of the biggest issues. And I'll get into the accounting aspect of that in just a second. But it's not just the accounting record keeping that you have to be aware of a landlord or as a taxpayer in general. You have all these general forms that you might receive, such as a W-2 or K-1 if you have various partnerships, or 1099s from brokerage accounts. So this record keeping aspect of it is really one of the hardest aspects. So typically, you're going to want to keep a folder, probably on Google Drive or something along those lines, of all of your documents related to your tax return. And as you start to receive them from the various, from the brokerage accounts, from your partnerships that you might be invested in, from your job, you're going to want to go ahead and put them into a folder so that everything is nice and neat and tidy. Otherwise, they can get out of hand very quickly and you're sorting through emails and paper documents. And if you are receiving anything via paper that you're not receiving via electronically as well, you want to go ahead and quickly take a snapshot of that. Everybody has phones these days, whether you have Apple or Android, whatever. Go ahead, snap that photo, put it into a folder. Now, when it comes to bookkeeping, especially when you have rental properties, this is critical because when you get into any business, rentals included, you're going to start having transactions, right? You're going to have income and you're going to have expenses. So income is going to be rental income that people are paying you to rent your property. At least hopefully you're receiving that. Now, on the expense side, you're going to be paying typically third parties various types of expenses. I'm talking about utilities, repairs, maintenance, professional fees, property taxes. The list goes on and on and on. So all of these typically going to flow through like a debit card or a credit card or your bank account. So you're going to want to make sure that that you're using a dedicated business bank account. So all your transactions are in one place. And then if you're going to be using a credit card or debit card, you want that to be, generally speaking, to be a business debit card or credit card. Again, so all your transactions are in one place. And when it comes to bookkeeping, it is tedious, it is time consuming, but it's one of those things you want to get in the habit of doing very early on in your journey, because things can easily start to pile up and become cluttered if you wait too long before you're on top of it. Now, the good news is as you start to build your portfolio, you can start to use software like Landlord Studio and others to get a system in place that you can operate yourself and link your bank accounts to and all that good stuff so that you can automate it as much as possible. And then as your portfolio grows, as your budget grows, you can start delegating out. You can delegate it to virtual assistants, to office managers, eventually a bookkeeper. So it's absolutely critical. You want to get on it right away, establish those good habits, and later just delegate it.
Super interesting. And we've sort of seen this as well. You typically come from if you're transitioning into software from spreadsheets and sort of this messiness, we really see this sort of epiphany happen when they start to shift into more automation and when they realize how much time saved, particularly at the end of tax season when they're handing all their records off to a CPA or doing their tax return. So yeah, that's really interesting. So one crucial aspect of sort of, for landlords is to be aware of, the tax filing deadlines. So missing deadlines is obviously very serious and can lead to serious penalties.
Yeah.
And basically, for most individuals, including landlords, tax filing deadline is typically April 15th. And, for us, we recommend that you'll mark that in the calendar and stay informed about any sort of challenges or changes in the deadline, especially if you need to file for tax extensions, for instance. So I guess a question for you, Thomas, aside from April 15th tax deadline, what are some of the key dates for landlords, and what do they need to know around that?
Yeah, absolutely. So the first deadline I'm going to mention, and better late than never kind of deadline, but so is if you are paying, if you're U.S. based and you're paying independent contractors $600 or more, then chances are you have a tax filing requirement for 1099 NECs that you have to report. These are due January 31st. So that's coming up quick. That's tomorrow. I'll give you a hint. There's ways you can do this. There's software out there. Google it. Google how to file 1099s online. You'll find software really quickly and efficiently on how to do it. But that's coming up tomorrow. Then you're going to have um, the March 15th deadline, which you need to be aware of. So March 15th is the filing deadline or the extension deadline if you're not going to file it for partnerships. So if you have partnerships and you're investing in rental property through partnerships, you're going to want to be aware of that deadline. You're either going to want to file your return or extend it, and extending it's perfectly fine, perfectly normal. In fact, majority of people I know do that, so that's fine. Now, interesting, on April 15th, it's not just the tax filing deadline. You could also extend your return by that date too. But it's also the date that if you have, it's the first quarter's estimated tax filing deadline, estimated tax payment. So if you run a business, then chances are you're gonna want to get with a qualified professional and ask them, do I need to make a quarterly tax payment for the first quarter of 2024? So that's when that first payment's due. Lastly, if you have IRAs or HSAs that you invest in, that's the last day you can invest in an IRA or HSA for 2023. So those are just the key deadlines to be aware of for this year. Lastly, September 15th is the last day you could file your partnership tax return if you have one. Same thing for S corporations. And then number two, the October 15th deadline is the last the deadline for filing your 1040, your individual tax returns.
There you go. So hopefully you've noted all those different tax deadlines down. But if you do work with the CPA, then they should be notifying you of these deadlines as well, and keeping you in the loop. There's a lot of resources on Thomas's website as well, therealestatecpa.com. Feel free to go on there. There's a ton of information that will be really useful for you as well. So let's just sort of move on and discuss some of the essential tax forms you, as a landlord, need to be really familiar with. So firstly, there's obviously the Schedule E, and that's a very important tax form, primary tax form, for reporting rental income and expenses, particularly if you're a sole owner in an LLC, for instance. So we're going to dive into that a little bit later. But another sort of question we have for Thomas is, what are some of the lesser known forms that real estate investors need to be aware of? You obviously mentioned the 1099 NEC. But what are some of the individual forms that are just sit outside the typical Schedule E when it comes to tax time?
Yeah, absolutely. I think the biggest one is going to be Form 8582. That's the passive activity loss form. That's so basically when you invest in rental real estate, it can generate losses in many cases thanks to depreciation, which is a non-cash expense. So what does that mean? You might be putting money in your pocket. You might be actually cash flow positive, but you're telling the IRS that you have a loss. Now, when you have a loss, real estate is passive by default. What that means is that this loss can only offset other passive income. So in other words, other rental income that you might have or capital gains from the sale of a rental property. It usually cannot offset your W-2 or active business income unless you're using certain strategies, which we may talk about later. But the bottom line is this. The bottom line is that Form 8582 is where these losses are captured and carried forward to your next tax return. So basically what happens is if you have a rental property, it generates a loss this year, say in 2024 or even in 2023, then what's going to happen is if you don't have enough passive income to offset it, so if your losses are greater than your passive income, then it gets suspended and carried forward to future years and can be used to offset passive income or gains from the sale of property in future years. And that's all done on Form 8582. And you want to make sure that you have that form on your tax return if you have losses or you're asking your CPA or tax preparer about it, because we see a lot of tax professionals failing to move that form up every year, carry that form over, and it could cause you to potentially lose some of those passive losses that you have, which can help you offset taxes later. So that's the number one form, Form 8582 outside of Schedule E. Another form is if you're doing short-term rentals and you're providing substantial services. Substantial services are hotel-like services that are found in a hotel: daily breakfast, daily cleaning, concierge services, tours, vouchers, things like that, ride services that are provided on behalf of your guests. This could trigger you to have to file not on Schedule E, but on Schedule C of your tax return. So that's just something. And Schedule C is where businesses are reported. So when you're providing these substantial services, you're treated like a business, not like a rental activity. That goes on Schedule C. So it's just something to be aware of. There's a few other forms that you might have to be aware of when you're filing rental properties. Form 4572. That's where assets that are depreciated are reported. So that's just something to be aware of. That will be generated by tax preparation software or by your tax preparer. So it's not something that you have to keep too top of mind, but it's just something to be aware of. And again, the Form 8582 is the number one form that I'd have to say is the one to keep an eye out on besides Schedule E for landlords.
And we'll be including a bit of a mini course that Thomas has put together with his team as well at the end of the webinar. So just stick around. I'll include that link. It includes a few videos that sort of go through all the real estate tax basics, which includes this as well. So it'll be really useful for you.
And one thing real quick. Sorry, I meant to say, I said Form 75, 4572. I meant to say Form 4562. So I apologize about that.
There's a lot of them, and that's, I guess, one of the reasons why you use a CPA who knows what they're talking about, because if you're just trying to do this stuff yourself, a lot of these forms are just going to get forgotten, and a lot of the details are going to get forgotten as well. So that's why we really encourage you to seek out a good CPA, particularly one who is sort of specialized in real estate. So when dealing with these forms, you must provide, a lot of accurate and complete information. And some of the common pitfalls include sort of incorrect calculations, missing deductions, or failing to report any sort of additional income sources. So I guess alongside records of your income and expenses, question for you, Thomas. What are some of the sort of key details and records you need at hand when it comes to filing taxes, and whether this is on the Schedule E or the other forms that you mentioned previously? Obviously, there's income and expenses, but what are some of the other sort of key details that you're going to need to know and have on hand?
Yeah, absolutely. So, of course, when you buy a rental property, it's not going to be, you don't just deduct the cost of the rental property on your tax return all at one time. Typically, rental properties are depreciated over a number of years, 27 and a half years for residential property and 39 years for commercial. And when you report down your tax return for the first time, and the way you tell the software, you tell your tax preparer how much to depreciate, you need the property. You typically need your closing statement. Your closing statement is going to have the cost of the property and various closing costs, and that's going to become your cost basis. And your accountant or your tax software is going to take that cost basis and start depreciating it over time. So that's something you're going to need to be able to provide your CPA, or you're going to need to have available when you're preparing your tax returns, is going to be that closing statement with that cost basis. Additionally, when it comes to ancillary kind of this kind of is in the expense category, but I feel like it's worth noting. If you're traveling back and forth between your properties via car, so you have a local rental property, you're going to want to keep a mileage log of the amount of miles you drove, because you're going to be able to deduct those miles as business miles on your tax return. And if you don't have that mileage log, you're A, not going to know how many miles you drove for business, and B, you're not going to be able to substantiate it in the event of an audit. So you're going to have that available. Same thing goes for the home office. If you're using a part of your home for business, then and you're actively managing your portfolio, you're typically able to claim the home office expense. And the home office expense, the way you substantiate that is by having a record of the expenses related to your home. But not only that, but you want to have proof that your home office is indeed a home office. So typically pictures can help with that. You want to have that. And then along with the expenses, a lot of it has to do with expenses and income, to be honest. But when you're basically, what I'm trying to say here is, when it comes to, sorry, I lost my train of thought in the middle of this thought here, so I do apologize. But basically, you want to have all the receipts, right? Because the receipts to all your expenses, if you ever get audited, you're going to want to have that for substantiation. And you can usually clip these, you usually put that into your bookkeeping system, but it's just another thing you want to have available. So those are the common things I see. I know a lot of them do fall under the expense category, but that is typically what I see people missing.
How long do you have to keep receipts for by IRS sort of standards or rules?
Yeah, so typically you'd want to keep them within. So typically they can audit you unless it's fraud for up to 3 years. So you're going to want to keep it for at least 3 years. Some people
Hmm.
tell you keep it for 7 just in case, like because there's different statutes and limitations. But three years the bare minimum. 7 years is what people is what if you want to be super safe.
And keeping receipts for 3 years in a folder is probably quite cumbersome and
Yeah,
and disorganized. So I guess that's where the value of some of these sort of softwares like Landlord Studio and having these sort of
right,
digitized systems can really help with that as well. So yeah,
exactly.
super interesting. Let's sort of move into part two, which is all about understanding the Schedule E form and deductible expense categories. So, Form 1040 Schedule E, so also known as the sort of supplemental income and loss form, is sort of where the magic happens for real estate investors. It's sort of the canvas where you report your rental income, deductible eligible expenses, and sort of calculate your overall tax liability, profit loss, and understanding its different parts from income reporting to expense deductions is really essential for accurate tax reporting. So part one, and I'll get your sort of input on this as well, Tom, but part one of the Schedule E is sort of where you report your rental income. So this includes the rent you receive from your tenants, any advance rent, any rental expenses paid by the tenant, etc. as well. So from there, part two of the Schedule E is all about sort of the expenses side. And here's where you need to list your total expenses by category for each property. You'll notice that there is a number of predefined expense categories in there, from advertising to auto travel, clean and maintenance. So really sort of categorizing expenses properly is going to help you fill this form out, because if you have a software or a method of doing that, all you need to do is just transfer the values straight across to this Schedule E form, as long as it's all categorized correctly. And that's going to help you really ensure that you claim deductions that you're actually entitled to while staying compliant with IRS regulations. Parts 3 and 4 of the Schedule E sort of cover cost of goods sold, conservation easements, respectively. And these sections might not apply to every landlord, but it's advisable to consult with your CPA and become familiar with these sections overall. So, question for you, Thomas: is there any sort of other areas of the Schedule E that's important to sort of note, or anything that you want to add to that? And additionally, when is the Schedule E not actually applicable to landlords or real estate investors?
Yeah, that's a great question. So, when it's not applicable is going to be when you are kind of like what I alluded to before a little bit, which is like if you're providing substantial services to your guests, you're going to typically then be reporting that on Schedule C of your tax return. So, again, that mostly applies to short-term rentals and hotels and perhaps motels, things of that nature, where you're providing those substantial services above and beyond simply renting it out to renting the space. So that's the first one. Next is going to be flipping properties. And what I mean by flipping properties, if you're buying a property for buying a property with the intent to rehab it, renovate it, and then resell it, typically that won't be reported on Schedule E either. You'll be considered a flipper or a dealer, more specifically, in the eyes of the IRS, and that will also go on Schedule C. Similarly, and I see this happen a lot, people confusion, especially among new investors, is when you're investing in a partnership. When you're investing in a partnership, you're going to be filing a form 1065. That's where that rental property will go. So it won't go directly on your form Schedule E. It will go on the partnership, and then you will receive a Schedule C, which is actually filed on Schedule E page 2, which is that's where your K1 will be reported. So those are some of the use cases where Schedule E may not be the form for your rental property or for your real estate.
I see there's a couple of questions in there, Vaughn. Is it applicable to house hackers who rent out part of their home?
Yeah, that's a great question. It typically is. Schedule E would be the form that you're filing when you're renting out part of your home. It would go on Schedule E.
And the Airbnb short-term rentals, would that be Schedule C or Schedule E?
Yeah, so let me specify that there. So if you have a short-term rental and you're simply renting out the space, so for example, say Brandy, say you rent it to me, right? And I go to your property, I rent it out, and I stay at your property, and then I leave. That's going to go on Schedule E. But however, let's say I go to your property and I rent it out, and you're providing me with daily breakfast. So every day I wake up and someone's making me breakfast. Every day I wake up and I leave, and someone cleans while I'm there, right? Like while I'm staying, like in the course of me staying at the property. These are the instances where you'd be treated more like a hotel. That's when it would go on Schedule C. But if all you're doing is just renting the space, that's still going to go on Schedule E.
Yeah, that's quite interesting, and probably in some cases there it could be quite a grey area
Oh, yeah.
for some people.
It's
Appreciate-
it's a nuanced area, but if you dive deep enough into the tax code, it says when to do it, when not
It's
to.
very explicit. Yeah, appreciate the question, Brandy and Von. So, accurate reporting on Schedule E isn't really just about complying with IRS regulations. It sort of directly impacts your overall tax liability as well. So, really, I guess here's a question for you. So, what happens when you don't have good records, and what are some of the results of sort of inaccurate reporting that you've seen in your own practice and throughout the community that you've sort of been a part of?
Yeah. So in the best case scenario, you report with the information that you do have, and you might be missing tax deductions. So, for example, because you don't have records of expenses, you might not be reporting. You might not even know that you spent them. You might not remember that you actually spent the money, and you don't report on your tax return. Or perhaps they're very large, and your CPA or tax preparer is like, look, without a receipt or an invoice or something to tell me that you actually spent that, like something, credit card statement, something, that you might not be able to, they might not let you deduct it, because then they don't have the record of it actually happening, right? So that's in the good case. Like that's in the best case, right? You're just missing information, you're missing deductions. On the worst case, you're perhaps reporting deductions you don't have substantiation for, and then you get audited, and the IRS, they ask you for the documents, and you can't produce those documents. And when that happens, the IRS says, well, we don't believe you, and then you lose the audit, and you have to pay back taxes, penalties, and interest, and that could be problematic. And if you're using some more of the advanced strategies, you don't have like time logs for certain things, then that can also be problematic as well. So really, again, just to summarize that, in the best case, you're just missing tax deductions. In the worst case, you're getting audited and you're paying back taxes, penalties, and interest.
Yeah, and that's something you definitely want to avoid.
Yeah.
We've seen the direct impact of that on some of the customers in the community, and it's something you just want to avoid.
Yeah, and rarely will you go to jail, so I don't want to scare anybody. Rarely will they get to that point, but yeah, it's not good.
It's just more of a big impact against your financial sort of position as well, and
Yeah,
really is just going to drag you behind those sort of long-term goals as well.
absolutely.
So, common Schedule E mistakes when sort of filing your Schedule E, whether it's sort of incorrect deductions or incorrect categorizations. What are some of the common mistakes that you've seen on the Schedule E, particularly when customers or landlords are sort of doing it themselves? What are some of those sort of key mistakes that you've seen, Tom?
There's a handful right off the bat. So the first, and I don't know why this is, but we commonly see insurance not reported as an expense on Schedule E. Like it happens. Like
Interesting.
it's weird. I don't know why that happens, but we don't see that. Sometimes we won't see people reporting property taxes on it. Sometimes we'll see people deducting their income tax. Like they'll deduct the tax they paid the government on Schedule E. So you typically at the federal level for the IRS, you don't get a tax deduction for the federal taxes you pay. But we've seen that happen. We've seen people not claim depreciation, and that's sometimes for not putting it in the tax software. That's sometimes not knowing what it is. Other times they don't claim it because they think if they don't claim it, that they won't be subject to depreciation recapture. So briefly, when you claim depreciation, you're lowering your cost basis. And when you later sell your property, basically you have to pay some of that back as a type of capital gain, basically, long story short. And people say, well, if I don't claim the depreciation, then I won't have to repay the recapture. Well, for many reasons, you don't want to do that. But one of them is that the IRS will actually assume you did take it anyway and charge you it anyway. So that's just another thing. Another area that we'll see is people they'll report their short-term rentals when they are providing substantial services on Schedule E. So that's one thing. Just trying to think of some of the other common little nuances that sometimes people see. Sometimes they won't put. Sometimes they'll batch all of their properties into one box. So if you look at Schedule E, what you'll have is you'll have multiple. You have on one page you'll have A, B, and C, and that's meant to do on a property by property basis. So you want to put each property in its own little box, its own little lane, if you will. And what ends up happening is you'll see people put everything in one, and that's no good either. So those are just some common mistakes.
And we're actually going to include a full Schedule E expense checklist at the end of the webinar as well. So you can download that, and that will really just help you sort of identify and avoid common pitfalls as well. So here's some of the sort of Schedule E expense categories on that form that you're going to see. I'd love if you could sort of take us through really briefly on, some of the main expense categories that landlords are typically going to fill out, Tom, and I guess just a sort of brief understanding about how these all work.
Yeah, absolutely. So advertising is like your marketing expenses, right? So to rent out a property, typically, you might rent it on put on Craigslist or apartments.com or rent.com, and they might have fees that they charge you for doing that. That would be advertising fees. If you put a sign outside of your property, that would be advertising fees. Now, that's conversely, that differs from commissions. Okay, so commissions is also listed there. Now, advertising is what I kind of just described. Now, when you have commissions, or maybe you have a website, that would also be advertising. Now, commissions, that's money you might pay a broker to rent your property. So you might say, hey, go out and find me a tenant, and that's where commissions would go, leasing commissions typically. Now, auto and travel, perhaps your property is out of state, right? Or perhaps you're driving to your property back and forth. That's where those expenses would go. Cleaning and maintenance. Cleaning and maintenance are for maintenance items, like perhaps you have landscapers, perhaps you have regular maintenance that's being performed on certain parts of the property, like the HVAC system that's regularly scheduled, and that's where the maintenance would go. Now, insurance includes basically any type of insurance that would be you put on your property. Typically, it might be flood insurance, uh, it might be homeowners insurance, or like the type of insurance you buy when you buy a house. Like that's would go in insurance. But you put any type of insurance that's related to your property into that insurance category. Legal and professional fees. So if you're working with an attorney to review lease agreements, or perhaps you're working with a CPA to file tax returns, or certain types of expenses that might go on there. Typically, your personal tax returns will not go on there, your personal part. But if you're doing business tax returns, that might go on Schedule E. Now, management fees. If you're paying a property manager, that's typically where that would go. Mortgage interest. That's interest that you'd have for your mortgage. Then you'd have other interest that might be credit card interest or other loans that you might have that are not your mortgage. Repairs, that's going to be repairs. Actually, one mistake I forgot to mention before, and I'll mention it here for repairs, is that when you have a repair, there's a difference between a repair and capital improvement. So a repair might be that a window is broken and you come and call somebody, they come and fix the window. A capital improvement might be you replace all the windows in the house. That's maybe a capital improvement in many cases. So the capital improvement, that's put on your depreciation schedule. And a repair is though put on Schedule E as an expense. And sometimes what we see as an error is people will double dip. So sometimes they'll put repairs, they'll deduct it as a repair, and then they'll also depreciate it. So that's no go. And also sometimes we'll see people put capital expenditures, like say they've replaced their roof. If you replace your roof, that's typically going to be a capital expenditure, and that's going to be depreciated. Sometimes they'll deduct the capital expenditures as a repair. So that's also another mistake. But repairs are typically things to fix small items of your property, not replacements of major systems or components of the property. Or improvements to the property. Supplies are relatively straightforward. These are little odds and ends you might have around the rental property to fix it, or to have just stuff on hand. Taxes, this is property taxes, not income taxes. So like I said before, some people deduct their income taxes on this line. No, this is going to be for property taxes. Utilities, that's water, sewage, electrical, whatever type of utilities you're incurring to run your property, that's going to go on that utilities category. Depreciation, that's going to be for depreciation, which again, I think we talked about a little bit today, which is when you buy a property, it's not fully deducted, it's depreciated little by little over the years. That's where that will go. And then this is just random little things like HOA fees sometimes go in there, bank fees might go in there from your bank. You might have just other odds and ends that don't have another category. That goes in that other category.
Yeah, it was quite interesting about the capital expenditure improvements versus repairs, because we also see that often as well. We actually have quite a cool feature in the expense tracking of Landlord Studio that sort of allows you to differentiate that, so that when you do run reports, you actually get a big full list of breakdown of, this was capital expense, this was just typically repairs.
Yeah, absolutely.
See a few more questions in the chat. Vaughn, Joanna, Ryan. We'll answer these at the end in the FAQs, just because some of these probably have quite a lot of detail. So we'll wait till then, and we'll answer them right at the end. So I want to jump into a little bit about depreciation. So this is obviously a really important expense, and one of the sort of wonders of real estate investing itself. So one of the most sort of significant deductions is obviously this depreciation, and that's allowing you to deduct the cost of your property of what the IRS deems as its useful life. And so for residential property, this is 27 and a half years, commercial property, slightly longer, 39 years. So really just want to get a bit of an overview of depreciation, how we should view it, and maybe sort of reference the cost segregation and accelerated depreciation as well, and common mistakes that sort of investors have when it comes to that. So I'd love to hear your thoughts on that, Thomas.
Yep. So depreciation is probably one of the most important expenses you have as a rental real estate owner, and that's because it's. I'll break it down like this. So I know we covered some of what I'm about to say, but here's the full picture, right? So depreciation is a non-cash expense. Sometimes people call it a phantom expense, and that's because it only exists on paper. And depreciation is the reason you get a depreciation expense is because when you buy a rental property, while it might actually appreciate in value, that's typically how real estate works, the actual property itself will literally fall apart over time. And you're going to have to make capital improvements to keep it up to date. Repairs, sometimes repairs are almost like little band-aids, if you will, but capital improvements, like eventually your roof is going to deteriorate and you're going to have to replace the entire roof. Your HVAC system is eventually not going to work as well anymore, and you're going to have to replace these major components. So you get a depreciation expense to kind of make up for it. That's kind of what depreciation is like. That's why you get the depreciation expense. Now, the way depreciation works is when you buy a rental property, you're buying a property, and it has land, it has the building, it has the components within the building. So one thing to note about depreciation is that land is never depreciated. So when you buy a property, your CPA is going to typically break a portion of is basically going to allocate, right? That's the word for it. Allocate a portion of the property's cost to land. This is typically done by an independent third-party appraisal. Well, they'll tell you how much the land is worth in comparison to the building, or perhaps by the property tax card. To kind of give you an example of how this might work, let's assume we have a $500,000 property, right? Well, let's just say 20% is allocated to land. So 20% goes to land. That's $100,000. This leaves you with $400,000 that would be allocated to the building. Now, the building is what's depreciated. So if you look at it over a 27 and a half year life, if it's residential, you're going to receive a depreciation expense every year, $14,445 and change, right? So that's going to be every single year you're going to get that depreciation expense over that 27 and a half year period. So now this is what I just described here, that 27 and a half, dividing the 400,000 by 27 and a half to give you that 14,545. That's known as straight line depreciation. Now, the thing is, when you buy that building, when you buy that property, the house or what have you, there's not just the structural components to it. There's going to be all these components that are inside, things like appliances, carpets, fixtures, all these little odds and ends that are in there that are depreciated over a shorter period of time. And then there's land improvements. These are things like landscaping, pools, decks, sheds. These all have lower class lives or depreciable lives than 27 and a half years. And the way you identify how much of your all these components is going to be through a cost segregation study. And a cost segregation study, typically the way it works is an engineer comes down to your property, they survey it, kind of like an appraisal, and they go back to their offices and they run it through their system, and they print out a report, and the report says that here are all of the components in your building. Here's the amount that's allocated to 5-year life, which is tangible personal property. Here's the amount that's 15-year property. Here's the amount that's 27 and a half year property, or 39 years in the case of commercial. Now, that 5 and 15-year property is eligible for accelerated depreciation, which just means that it's depreciated over a shorter period of time. And not only is it depreciated over, say, 5 and 15 years, but there's actually something called the double declining balance, which means that it's depreciated faster. So more of that depreciation, you're getting more of that depreciation up front and less as that 5 or 15-year cycle goes on. But the Tax Cuts and Jobs Act gave us something even better. It's called bonus depreciation. And bonus depreciation allows you to significantly accelerate that expense. So the way it worked from the tail end of 2017, that was September 27th. Don't ask me why they chose that date. I don't know. Very random. But from September, there's some rhyme or reason for it, but whatever. From the 27th of September 2017 through December 31st, 2022, you had 100% bonus depreciation. So that meant that 100% of that 5 and 15-year property was depreciated in the first year, which substantially increased your depreciation expense. And I'll give you an example of how powerful this is in a second. Now, that depreciation, that bonus depreciation starts to phase out 20% per year from starting in 2023. So it was 80%. This year in 2024, it's 60%. 2025 will be 20, and 2025 will be 40, and 2026 is 20, and then it's gone under current law. Now, interestingly, there's a bill that's said to be voted on by the House as early as tomorrow. Okay, so if you're listening to this on replay, it's the 30th of January, 2024, that might extend 100% bonus depreciation retroactively from 2023 through 2024 and 2025. So 100% bonus depreciation could be making a comeback. We will see. But to give you a quick example, let's go back to our $500,000 property. So that $100,000 of land is not depreciated at all. So that just sits there on your depreciation schedule as land. Now, let's just say that out of that $400,000, somewhere usually with cost segregation, somewhere between 20 and 30% of that $400,000 will be allocated to 5 to 15-year property. Let's just split the difference. We'll go to 25. That's $100,000. So in the first year under 100% bonus depreciation, you're deducting $100,000 plus the amount remaining for 27 and a half year. Now, under 80% bonus depreciation, which was 2023, that's going to be 80,000. If it was this year, you bought the property this year, it's going to be 60. It's going to be 60%, so it'll be 60,000. And of course, if they bring 100% bonus depreciation back, it'll go back to you get 100. So that's the power. And now when you might only make $10,000 on your rental property, you have all your other expenses, and now you're reporting this massive, $60,000 to $100,000 expense that's non-cash on your tax return. And what's going to happen is you're going to have a sizable loss. And now, again, it'll get suspended, carried forward. But if you have other strategies, I see some people asking about the real estate professional status. We'll get to that later on. That could help you offset your W-2 or active business income, significantly reducing your taxes. So that is why, in a nutshell, as quickly as I could go through it, is depreciation is so powerful. It is because it can help you save a lot of money in taxes and shelters your rental income from tax.
The eighth wonder of the world, they say. So there's some really good information in there. So be, I guess, diligent around keeping an eye on this 100% bonus as well. Make sure you ask your CPA, reach out to Thomas and his team if you want to learn more about that as well, because I think that is going to be very significant going forward. So let's sort of jump into, as a side swipe here, the importance of sort of keeping receipts and reconciling transactions itself. So first and foremost, we want to sort of stress the importance of keeping receipts and regularly reconciling transactions. And every expense related to your rental property should be documented, and your receipts should be digitized, saved as crucial evidence. As Tom said previously, 3 years is typically how long you should be keeping these receipts on file for, but even up to 7 years. This is all in case of an audit. So making sure that you're really just being diligent around this. And reconciling transactions is equally vital as well. So regularly reviewing your bank statements, invoices, receipts, and comparing them to your sort of recorded expenses is going to help you identify any discrepancies. And as Thomas sort of alluded to before, having separate bank accounts to make sure that all your transactions are separated from personal expenses is really going to help you keep on top of this process, avoid errors in reporting, providing a sort of clear trail of your financial activities as well. And it sort of makes that whole tax preparation process just a lot more smoother. And of course, it goes without saying, using tools like Landlord Studio or other sort of software is really the easiest way to do this. Otherwise, you will be exporting bank statements out, putting them into spreadsheets, and then trying to figure out exactly which expenses are going into which area and which category. So sort of going, I mean, depreciation, capital expenses, there's all these really great tools that the IRS has given you in order to make your tax liability just a lot easier to manage. So just sort of dive into the deductible expenses versus capital expenses as well. So understanding the distinction between deductible expenses, for instance, repairs, so replacing a glass window versus replacing all the windows, or any sort of areas of the house that will ultimately depreciate over time, or run its useful life over time. And how to treat them is really essential for maximizing your deductions and sort of complying with IRS regulations. So rental property tax deductions are sort of the cost associated with day-to-day operations and maintenance of your rental property. And these expenses are fully deductible in the year they are incurred. Passive loss limitations aside, and some examples of that include, like Thomas alluded to before, repairs to windows, utilities, property management fees, insurance, making sure that you're deducting insurance is key as well, advertising costs, etc. So these deductible expenses directly reduce your taxable income for that tax year. But capital expenses, obviously, slightly different. On the other hand, capital expenses are the costs that improve your property's value, extend the useful life. These expenses are not fully deductible, as Thomas sort of alluded to, in the year that they occurred. So that's basically, what IRS deems their useful life, and sort of examples of that could be, significant renovations, such as repairing the roof, repairing windows, or all the windows, all the doors, things that are going to ultimately improve the capital value of the property. So sort of going back to your depreciation sort of insights and how that sort of ties together with capital expenses, do you have a real life example of sort of how, a real life example from a landlord of how they've needed to sort of clarify capital expenses and how they've needed to be tracked and then depreciation, or any sort of examples of your own clients of what they've learned along the process, I guess?
Yeah, I could say this, right? So repairs, those are typically deducted as operating expenses, but when it comes to larger expenses, like for example, if you were to have an HVAC system, right? An HVAC system is a good example of this because there's multiple components. And you replace one component of that HVAC system, like you have some come and repair, and they just have to repair one little component of it, and you're good to go. That's typically going to be a repair. You're moving on. If they come and replace the entire HVAC system, that's going to be considered a capital expense because it's improving or extending the useful life of that HVAC system. Like when you replace it, you're getting a whole new one. And that's a capital expenditure, and capital expenditures are depreciated. So that's the best way to look at it. Capital expenditure is depreciated, a repair is deducted. And examples of stuff are, I keep going back to the roof because it's some of the most common examples. The roof, the HVAC system. Another one might be, trying to think just like big examples other people might see, right?
Driveway replacements, or
yeah, land improvements, right? Okay, land improvements is another good one. Like if you're having a deck built, right, that deck is going to be a capital improvement. That's going to be depreciated. If you have a deck and you're replacing a few planks on the deck, that's going to be a repair. Painting is usually considered maintenance. So if you have to paint that deck, that's going to be maintenance. If you're putting a pool into the property, that's going to be considered a capital expenditure. If you're getting the lining in the pool replaced, that's when we have to start looking at it a little bit more closely. And I didn't mention this before, but these rules of repairs versus capital improvements are so complex. They had to release something called the Tangible Property Regulations, the TPRs. And it's a massive document. I can't even tell you how many pages, a lot of pages that kind of detail out when something is expensed or when something is capital improvement. And I chuckled there a little bit because it sounds so simple, but it's so nuanced. So the way I could say this is this: if you're replacing something, material component of your property, chances are it's an improvement and it's a capital expense that needs to be depreciated. If you if you're simply just fixing it, replacing a few components of it, it's typically going to be a repair. The bigger, so I'm just pointing some guidelines here, right? The bigger the expense, the more expensive it is, the more likely it is in general to be a capital improvement. And then trying to think like there's any other like okay, here's a big one. The de minimis safe harbor. So there's a lot of nuances of like, is something a repair or a capital improvement? It's so complex, like I said, with all these documents. The IRS gave us a tool. They said if it's under $2,500, so $2,500, you can just deduct it as an expense, as a repair or maintenance item. And we're going to call that the de minimis safe harbor because and it's actually a bookkeeping component. It's how you keep your books and records. So they did it because they said, you know what? You know how many little things you'd have to put on your depreciation schedule if you had to go ahead and capitalize a $1,400 appliance. So appliance, here's a good example. An appliance is typically a capital expense and it's depreciated over 5 years. But an appliance might cost you $1,200. So if you go and you have a $1,200 like stove or whatever the case is, that can actually be deducted as an expense using the de minimis safe harbor. So again, I could probably do a 2-hour presentation just on this, but like those are the guidelines I could provide, and hopefully there was some clarity there on that.
See Ryan's commenting in the chat. We'll cover that question off at the end. Ryan's part of our community, so that's a good question that I'm quite keen to get Thomas's insight on. But let's shift into the sort of final part of the webinar, and that's all about sort of using the old manual methods of spreadsheets and paper receipts and all those sorts of manual methods of keeping your bookkeeping versus real estate software, and particularly using these two different methods in order to minimize tax liability ultimately. So I guess the limitations of traditional spreadsheet methods, managing multiple properties. So this is particularly important if you have a long-term vision of growing wealth and growing your portfolio and buying more properties and renting and having multiple different types of properties, single-family homes, multi-family, short-term rentals, house hacking, flipping, etc. There's a lot of different components going on here. And basically using spreadsheets to manage that entire portfolio can really lead to errors, misplaced data, and an overall sort of lack of cohesion, understanding where your financial position is. And it doesn't only cause you frustration, but ultimately your CPA. And I'm sure Thomas has had examples of clients come in with really messy spreadsheets and bank statements that has ultimately cost the client more money because it takes a lot more time for the CPA to figure out and decipher exactly what's going on from a financial point of view. So, Thomas, talk about your experience with dealing with investors who use spreadsheets and what are some of the challenges that they've faced, and ultimately how do you as your team deal with this? I'm assuming that you now have a blanket statement where you need to have a system in place for clients that are going to come on board.
Yeah. So there's a lot of challenges. I think the first challenge is keeping it up to date, right? Because it's a very manual process usually, and you can get fancy with automations and like Zapier and trying to figure that out. But if you're going to go through all of that, I would honestly say just go get a bookkeeping system like Landlord Studio and just save yourself the time and energy and just do it right from the beginning. But it's the fact that you have to manually input everything and you have to manually update it. And if you let it slide, it could take, you could have a lot of different transactions that you now have to go and manually reconcile, add up with a calculator, and then drop it into the spreadsheet, or go ahead and put equals into the spreadsheet plus for all the expenses. Like, you don't want to have to deal with that. That's one of the biggest challenges, is just keeping it up to date, because of it's so tedious to deal with from a manual perspective. The other thing is inconsistency in the way people keep their spreadsheets. I've seen people who just copy Schedule E and just put their expenses in Schedule E and send it over. That was like the best types of spreadsheets that we see because it's very easy. And then you have people who have these convoluted, like, it only makes sense to them. And you're like, what is going on here? And you get on the phone with them and they don't even know what's going on there. So it becomes crazy. So the way I look at it is this, like, if, and my view has changed on this over the years. I used to be like one of those scrappy entrepreneurial penny pinchers who's like, you know what, I'm going to use the spreadsheet because I'm going to save myself a few bucks. But then as I gotten more sophisticated, I guess you could say, like, I would say just go get the right software right off the bat, build the right habits, automate it. Software like Landlord Studio is going to help you do this tremendously. And you might think that, oh, I'm saving a few bucks by not doing it. But trust me, you're costing yourself a lot of time, which eventually becomes money, frustration, your quality of life, and you're building bad habits by not doing it the right way. So my advice would be that even if you have just one rental property, like, while you could maybe get away with a spreadsheet, okay, I'll give it to you. But like, even then, if you're a serious landlord and you want to do this and you're going to be doing this, if you're going to be in the game for a long time, which you should be as a landlord, right? Like, real estate's a long game, and you're going to want to have the right systems in place, the right foundation of your business. And that starts with bookkeeping. It's critical. And just spreadsheets are frustrating because, like I said, tedious manual updating, and who knows what format you're going to have it in, and what types of errors and things get deleted, and your hard drive gets wiped, your account gets hacked. Is not good.
Yeah, and we've definitely seen some nightmare situations of people losing spreadsheets and data corruption and all that sort of stuff. And that just ultimately leads to a world of just mess and frustration.
Yeah.
And I guess it just ultimately drags you away from that longer term vision of creating financial wealth and financial stability in your life as well. So even though it sort of seems like it could be worst case, the worst case does happen to people. And I think that's really important to understand.
Yeah, and if I could add one more thing too, like, it's not just about taxes, right? Tax is a major reason. It's a major reason to keep good books and records and use a system, right? But it's also your ability to keep a pulse on the financial health of your business. If you have to manually update a spreadsheet every time you turn around, you're not going to do it, and you're not going to be able to say how much money are you making or losing with the property. Like, here's a good example. We ended up getting someone's books up to date finally, and we looked at their profit and loss statement across all the properties they had in the market. And one of their properties had a huge utility bill, like, compared to the rest. And we said, well, why is that? Like, why is this utility bill so high? And they found out there's like a leaky water pipe that was underground that wasn't necessarily flooding. So there was no outward visible signs of this happening, but that was causing a water leak, and over time that just kept creeping up their utility bill. And they were able to find that through bookkeeping, not through a puddle on the floor. So it's not just about taxes, although that is a very, very good reason to do it the right way. But it's also about understanding the financial health of your business, and you can actually use this data then to make good decisions that can improve the performance of your property and ultimately make you more profitable. So
Yeah, that's great insight. So with that, I want to sort of introduce Landlord Studio. We've talked about it a few times. I want to sort of dive into it really briefly and give a slight demo of a few minutes to really just show you exactly how this works from a visual sort of point of view. So Landlord Studio is a modern, user-friendly rental accounting property management tool as well. So it's sort of split into two halves. You've got this accounting side, which is great for understanding financial health, the tax side, and then there's the management side as well. And that's all about systemizing day-to-day, whether it's rent collection, tenant screening, listings, all the sort of components that you're going to have to actually deal with anyways on a day-to-day, particularly when it comes to tenants. we know the accounting aspect is this sort of, for some people, this sort of once a year date in their calendar, and they sort of leave it to the last minute. And what we do is we make the process a lot easier so that actually through the year, you can understand exactly what's going on in your portfolio, whilst bringing in all the other tools to help you deal with tenants, etc. So some of the key features of that is the automated income and expense tracking. This is key. Similar to accounting software where you have bank feeds, where you can sort of securely connect your bank account, bring in all the transactions automatically. It means that you can set up rules to automatically categorize expenses without you having to download bank statements and all that sort of stuff. The receipts, this is a really core component as well. The mobile app allows you to take photos, pull the information off, automatically fill out your expense fields, and then keep that securely on file so that in the case of an audit, you can always bring that out. And then the two other components are the tax reporting. So you can generate your Schedule E instantly. And this is what really is the game changer about tax time. Simply click a button, Schedule E is generated, and it has all your pre-categorized values in all the different categories. So all you need to do is just hand that over to your CPA, and they can just copy those values straight into the Schedule E tax return form. And then beyond the sort of tax prep, rent collection, so online rent payments for tenants, maintenance tracking, tenant screening, listings is coming up as well. We're about to release that feature where you can market your property through Zillow, Zumper, Hotpads, Trulia, etc. So all of these sort of components make the property management side just a lot easier. So I'm going to jump into a really sort of short demo. This is all about getting set up with Landlord Studio. So sort of getting set up is quite easy. Just create your account online. And then basically just add in a few details, and then we help sort of personalize the experience getting into it. And then all you need to do is just add your first property to start with. And so how this works is we automatically pull all that information in, and then you can add it as an HMO multi-unit, and then simply click continue, and then you're set up, ready to go. So basically, getting started is really easy. And then we have this quick start guide, which allows you to basically get onboarded quickly. So adding in the expense accounting information is sort of the first steps to this whole process. Importing from a CSV file. So if you want to get all your information up to date really quickly, you can do that. Simply import the bank statement, map all the transactions, whether they're paid by tenants, capital expenses. This allows you to get your whole account set up, ready to go, and really just helps you just to stay on top of it straight away. Now, recording rent is really easy as well. So we have a full lease sort of system built into Landlord Studio where you can create your lease, add your leases to the property. This is all the start date and allows you to keep everything on file, the payment dates, end dates. Ultimately, it's keeping a sort of automated balance for the lease so that you always know how much rent is due. You always know when the rent is due. You can send rent reminders out to tenants, invoices, expiry reminders, all the sort of automation aspects around sort of keeping on top of that day to day. And we even log all the payments historically. So if you want to create a property sort of lease in the past, then we can bring all that up to date. And then ultimately, this is where all the automation starts to happen. This is one of our core features, which is bank feeds. And bank feeds is all about automating the reconciling process. So we allow you to securely connect your bank account via Plaid. And this is very similar to how QuickBooks and Xero and some of the other sort of accounting softwares work. They allow you to securely add in all your bank accounts, whether it's your credit card, whether it's the mortgage account, whether it's checking, savings, etc., etc. all that is brought into Landlord Studio in a read-only sort of fashion. And then we automatically import all those transactions every time you come to this page. And so you can see here, we have already found some matches. And that's basically our automation engine saying this transaction we know is going to this property and we know it's for this particular category as well. And so what you see here is a full sort of breakdown of the transactions where you can do fancy things like create rules and automatically apply these different transactions to different properties. You can even split it across different properties. So in the case of a transaction or an expense being applied for sort of multiple properties, you can actually split that across multiple properties automatically as well. And that just makes the whole sort of reconciling process a lot easier. And so what I'm doing here is essentially just going through and clicking OK. We've already set up these rules, and it's just making that whole process of reconciling and importing transactions just that much easier. And basically what that allows me to do is bring everything into Landlord Studio and then now start to visualize all this information on a dashboard. So when we were sort of talking about this before, having financial insight into the portfolio is key on an ongoing basis, not just at the end of tax season. And so in this case, what we've used is the dashboard to then dive into individual transactions and generate one of the reports and sort of show a full breakdown of all the transactions for a specific property. And so here we're sort of generating an income and expense statement. And this is really similar to how a Schedule E is effectively designed. So here's a trailing 12-month statement. We can filter out different types of capital expenses. We can filter those out. We can filter out expenses paid by the tenant. And then we can start to view this information in a PDF format, CSV file. So all this information can be shared with the accountant. In this particular one, we've got a Schedule E. So in the case of the tax time now, we actually generate a full Schedule E, even listing all the days rented, the occupancy rate, the type of property. And these are some sort of optional types of fields in the Schedule E. We bring this all into a report so that when you do go to engage with your CPA, you can actually just send it through to them. You can email that through to your CPA or generate the PDF file, generate the CSV, send it across to them. And that just makes the whole process of tax time just that much easier for your accountant and for just going through that whole process. There's some other sort of key features in here, such as reminders. There's a full calendar view. It means that you can stay on top of sort of some of those key components. So that's a really quick overview of how Landlord Studio works and how it sort of works from a web portal point of view, but it's also available on the mobile app as well, so you can manage it anywhere. How does the program work for short-term rentals? So basically, a short-term rental is just defined as the type of lease that you're operating in Landlord Studio. So you can simply set the property up and then basically define it as a short-term lease or a one-off lease or an Airbnb lease is what we call it in the property. And that basically creates a line item saying this is an Airbnb payment, for instance. So that's basically a bit about Landlord Studio and how you can start to automate all these things for tax time. So it's more than just an accounting and tax prep sort of software. It does include a lot of those other types of tools and automation processes that are really going to help you. So one of those tools is the rent collection. So we do full ACH payments online. That automates the whole bank-to-bank transfer. It's all defined off leases. It's all controlled within the Landlord Studio environment so that tenants can't overpay or do partial payments or miss payments. You can set up automatic payments, etc. Maintenance tracking, this is another one. This is also quite key when it comes to sort of doing supplier reports as well. So our expenses track all supplier type expenses. So if you're going to issue a 1099, then you can easily do that from Landlord Studio. And it's all tied into the maintenance tracking as well, where tenants can sort of raise maintenance requests. Tenant screening. So if you are leasing, we're going to go into sort of leasing period around June, July. That's typically when a lot of tenants start to move in. We have a full listing platform and tenant screening and leads management tool built into Landlord Studio. So that's going to really help you with that. And then ultimately, financial reporting, few clicks, you can generate all these reports, which are just going to make your CPA's life a lot easier and ultimately save yourself some money when it comes to those bills. So some of the sort of advantages of using an all-in-one system versus the spreadsheets, or multiple types of products. So instead of sort of juggling all those types of tools, you can just centralize it all in one place, and that will, really help you streamline, save you time, reduce the costs, and allow you to sort of focus on the day-to-day and what really matters, which is growing your real estate investments ultimately. So I want to jump into some questions now. I know there was a few in the chat. Hopefully you've learnt a few things about how to understand the Schedule E, how to understand the categories, depreciation, CapEx, and ultimately how you can do that in Landlord Studio as well. So I'll just jump into some of the questions. There was one question about the real estate professional tax status for you, Thomas. I could surely make the case that my real estate activity takes over 750 hours and over 50% of my time. I'm just curious how strictly the IRS will audit this if they claim, or if he claims that status.
Yeah, that's a great question. So this is one of the most highly litigated areas of the tax code. There's over 500 tax court cases, and it's virtually impossible to qualify and substantiate it and win an audit or a tax court case if you have a full-time W-2 job. And this has been proven time and time again since this has been out since the 90s, over the last 3 or 4 decades or so now. And so if you have a full-time W-2 job, the IRS looks at it as you're working 2,080 hours per year at the job. So it's about 40 hours per week. And to claim that you worked more than 50% of your working time, you'd have to have 2,081 hours in real estate, which means you're working 81 hours per week, for the entire year. And most people, at first, it is very hard to actually make that happen, actually do that and substantiate it. It's a whole nother thing. So there was really only one tax court case where someone had a full-time job, and say full-time in parentheses, because they were a boat pilot and they were able to prove that they spent a lot less than 2,080 hours. And they had testimony from several character witnesses, basically, that said this person has an extreme work ethic, a crazy work ethic. And the IRS, the IRS audited them, and they went to tax court. And the tax court basically said, we're going to side with the taxpayer in this case. But that was one out of many cases. So if you have a full-time W-2 job, I'm going to have to recommend that you do not claim the real estate professional status. You're playing audit roulette, and it's a red flag by the IRS, so you might get pulled for it. And I'm not trying to be, the bad guy here. I'm just for your own good, don't do it. Now, if you're doing 1099s, you might, or you have or perhaps for business you're running, you might have a little wiggle room in there, but also probably not recommended. So that's all I have to say on that.
Yeah, that's good advice. Joanna had a question. For a partial year rental, are the personal use days in part 2 for the whole year, or from when it was available to rent?
So yeah, that's a great question. So real quick, I wanted to throw out there from before. I know someone asked about if I rent out the house on my rent it out to my house, do I put on Schedule E? If you rent it out for less than for 14 days or less, it's not going to go on Schedule E. You don't have to report it at all. Like it's just if you so it's called the Masters Rule or the Augusta Rule, and it was put in place for the golf tournament down in Georgia. And if you basically rented your property for 14 days or less, you just don't report it at all. So it doesn't go on Schedule E in that case. If you rent your house more than 14 days, so 15 days or more, then it will go on Schedule E. And are the personal use days in part two for the whole year or just when it was available for rent? So I'm actually going to pull up Schedule E right now just to take a quick look to verify for you. So on part two, is it just okay? So for personal use days, those would be the days you used it personally. So are those personal use days in part two for the whole year or just from when it was available for rent? Okay, I see what you're saying. You're saying if you place it in a service, is that when it starts? And the answer to your question is yes. So say for example, and I see what she's saying here. So say for example, you lived in the house full time, didn't rent it out through April 1st. Then on April 1st, you started renting it out. So that would be the date it's placed in service. The personal use days would start that day. So like if you rent it, so if you place it in service April 1st and you stayed at the property for say 4 days, you would have 4 days of personal use that year because you placed the property in service on April 1st. Even though you stayed in it from January 1st, presumably to April 1st or January or March 31st, those days don't count because the property wasn't placed in service yet as a rental. So
Hopefully that answered your question, Joanna. Ryan, if you put commissions in the advertising section inadvertently, or just make it simple, marketing commissions, etc., all in one bucket of advertising, does it really cause any issues when it comes to, I guess, the tax return?
it's hard to say definitively. Chances are you'll probably be fine. However, sometimes the IRS does run like these like statistical things. So let's say, okay, look at all these properties in this market, for example, or in this space, this category, what have you, and this is the percentage that should normally be in each category. And if it's so far if it's an outlier because you put everything in one category and it's so high that they flag it, it could be problematic. But I mean, it's hard. I mean, to be honest with you, it's hard for me to say as a professional, as a CPA, but you're probably fine. You know what I mean? More times than not. But ideally, you're categorizing things properly so you avoid any issues. But again, it's probably not gonna be the end of the world.
Hopefully that answered your question, Ryan. And I know you had another question about reporting income and expenses to the exact penny or rounded up to the whole dollar. So
yeah. So tax software actually rounds it up or down. So on the tax return, you at least I've not seen in recent memory, at least I remember. You won't see like $314.57. You'll just see 315. So it rounds it up in the tax software for you, or most tax software will automatically round it up or down.
I did not know that. That's an interesting piece of information. We don't round it up or down in Landlord Studio. We use the whole sort of value because it's reconciled directly to a bank transaction in this case. But in the case of tax prep software, so this is the software that the CPA uses to actually do the tax return to the IRS. What Thomas is saying is that it does round it up or down. So if you are giving your CPA a rounded up version of your income and expenses, then it shouldn't make an impact because it's going to do that anyways in the software.
Yeah.
Interesting. There you go, Ryan. Always round up and down. Let's do it, Logan. Write the code. Ryan's one of our customers, so he's a good friend. Couple more questions. Is there any plan to be able to add a subcategory in some of the expenses? So I'm assuming you're talking about Landlord Studio. So if you're reporting on the Schedule E, typically you're going to have to use the categories of the Schedule E. And so that's what our software does. It's pre-creating when you set up your account, basically all the categories per the Schedule E. If you're going to split it out into subcategories, my recommendation, you can do that. You can create separate categories in Landlord Studio, but it really depends on how you are working with your CPA, because they may or may not want you to do that. But if you're doing it purely to just understand a sort of breakout in the software and understand the sort of financial aspect in different areas, then there's nothing stopping you doing that in Landlord Studio. But again, when it comes to the tax return, you're going to have to somehow aggregate that into the Schedule E categories, or whatever form you are using to report your income. Can we input all of our info for 2023 now to get the Schedule E put together? So you can import, in Landlord Studio's case, yep, you can import all your info now. You can get everything up to date either through the bank feed to easily reconcile everything, or import a bank statement straight into Landlord Studio, or just manually add those. There's no issues that you see, Thomas, with sort of preparing for the Schedule E now, getting all the info from the past year. A lot of clients probably are doing that. They're getting all the information from the past tax year now for that Schedule E.
Yeah, a lot of people are getting that. So, some people are proactive, and hopefully, proactive will be in the future for many people listening to this. But yeah, there's definitely a lot of people right now pulling all that information together and uploading it to us, and like getting it all prepared so that we could ultimately file their return. But I think I see the question: can we input all our information 23 now to get Schedule E put together?
There's no issues with that.
It can be done. It can be done. Proactive is best. I promise. I promise. I'm not just saying that here just to say it. It's better to do it proactively than not do it proactively.
Yeah,
I promise.
Set the goal for 2024 to be doing your bookkeeping every month and keeping that all up to date. Would be our recommendation. We'll take 2 more questions and then we'll wrap up. We've gone over a bit of time today, but really appreciate everyone sticking around. So, Brandy, what category do you expense furniture or other furnishings for the short-term rental?
Yeah, that's a great question. So furniture is typically considered 5-year property. So that was typically going to be capitalized and depreciated. However, if the furniture does fall under that $2,500 or $2,500 limit I mentioned before, and that's per invoice or invoice line item if you get the invoice itemized. So that if that's the case, it would typically go under like repairs or other. We'd see that maybe go under one of those categories. Depending on it's hard to say. Other is probably the most appropriate. I've seen people label it like de minimis safe harbor other. So that's debatable, but that's typically how it works.
Cool. So I think we'll join it. We'll end it there today. Really appreciate everyone joining in today. Really appreciate all your insight, Thomas. And it looks like a lot of people got a lot of value from that. So my recommendation would definitely be to reach out to Thomas and his team if you're wanting to know a little bit more about real estate tax specifically. Their team is amazing at all this. So reach out to them. Just want to do a quick recap of some of the key takeaways. So first and foremost, accurate bookkeeping. We said it just before. Make sure that you're doing that every single month, keeping it up to date. It is the bedrock of a successful real estate portfolio, and ultimately for tax preparation as well. So keeping meticulous records ensures you to sort of navigate the complexities of the tax forms too. We sort of explored the importance of proper categorization. Again, reach out to a CPA if you're unsure of this. If you're doing it yourself, reach out to a CPA, and a real estate specific CPA as well, because ultimately their knowledge is going to help you with your tax liability and set you up for long-term wealth. And yeah, finally, I just want to express gratitude towards you, Thomas. Really appreciate all your experience and sort of invaluable insights. Where can people sort of go to find more about you and the business?
Yeah. So thank you for having me. I appreciate it, Logan. It's been great today. So you can find out more if you're looking for a new CPA or CPA firm. You go to the realstatecpa.com/Thomas. You'll be able to learn more. I'm also over social media. If you Google, I'm sure you'll find me, or the Tax Smart REI podcast. That's out on all major podcast platforms, Apple, Spotify. A great resource to learn about taxes and how you can use real estate to reduce your tax liability.
I've just dropped a link into the chat. This is a real estate tax course it's sort of crash course that Thomas put together. It's by the Real Estate CPA. There's 5 modules in there that you can go into, and they sort of cover off a few of the things that we've covered off in this webinar, but in a little bit more detail, including sort of entity structure, passive activity rules, business travel expenses, etc. And then looking at the Schedule E and the Form 8582. So check that out. Some great information in there. And also check out their website as well. If you're looking for more of a specialized CPA that's going to help you long term, I think their team is going to be great for that. So really appreciate that, Thomas. And once again, thanks everyone for joining in today. We wish you the best of luck with the future real estate investments. And if you want to take advantage of all the benefits of Landlord Studio, you can get started for free. It's free up to 3 properties. So you can get started easily at landlordstudio.com. So check that out. Sign up for a free account and take a dive into it. So appreciate everyone joining in today. And thanks again, Tom, for joining us.
All right. Bye now.
All right. Cheers.